You know, the market today, it can feel more like a casino than a place for serious investing, right? It's just chaos. So how do you cut through all that noise? Today, that's exactly what we're going to do. We're going to explore the massive difference between frantic speculation and disciplined investing. And by the end of this, I promise, you'll have a clear framework to navigate any market, whether it's calm or completely crazy.
You know, the late great Charlie Munger just nailed it with this quote. He saw this growing trend of people treating the stock market like it was a horse race, just betting on whatever's hot, hoping for a lucky win, instead of, actually analyzing the business behind the stock. And this really sets the stage for the two completely different games being played in the market today.
And this slide, wow, it just lays it all out, doesn't it? On one side, you've got the speculator. This person is all about chasing prices, totally fueled by FOMO, the fear of missing out, and envy. On the other side, you have the investor. They're disciplined, patient, and laser-focused on the actual value of a business. One is trying to get rich quick, the other is aiming to build real wealth, slowly and surely over the long haul.
All right, so here's our game plan. First, we're going to dive deep into the psychology of a market frenzy. Then we'll shift gears and talk about the investor's core philosophy. After that, we'll build a really powerful three-part framework you can use to analyze any company. And finally, we'll wrap it all up in a simple playbook you can start using right away.
Okay, let's dive right in. Section 1, the market frenzy. Because look, to build a solid framework for rational investing, we first have to understand the powerful, and let's be honest, often irrational forces that we're up against.
And you can't talk about market frenzy today without talking about the meme stock. Look, we're not talking about companies with solid fundamentals here. We're talking about stocks whose prices are driven almost entirely by social media hype, usually coordinated on forums like Reddit's Wall Street Bets. It's all about a powerful narrative that pits the little guy against the big institutions.
And what's wild is that this whole movement has its own language, its own culture. You hear terms like diamond hands, which is basically a vow to hold on for dear life no matter what. And then there are tendies, which is just slang for profits. This isn't your typical Wall Street jargon. It's the language of a community built around a culture of super high-risk, high-reward trading.
And this is where a quote from Warren Buffett really hits home. In a frenzy, the why you're buying something just gets thrown out the window. The only thing that matters is that the price is going up. And when you see other people making what looks like easy money, that's when two of the most powerful emotions in investing kick in: greed and, honestly, the one that's even more powerful, envy. It creates this feedback loop that can pump up bubbles to absolutely insane levels before they, well, inevitably pop.
Okay, so we've seen the chaos, we've looked into the frenzy. Now let's talk about the antidote. This is Section 2, the investor's core philosophy. This is the mindset that guides the most successful long-term investors, no matter what the market is doing.
This line right here, this is a core belief for investors like Munger. Real wealth isn't made by frantically buying and selling, running on that hamster wheel trying to time the market. No, it's found by identifying truly wonderful businesses and then having the patience, the discipline to just sit and let them grow and compound value over years, sometimes even decades. So what does that patient mindset actually look like? Well, this slide breaks it down into some key principles. A real investor knows their circle of competence. They don't need to have an opinion on every stock out there. Instead, they wait patiently for that one rare, amazing opportunity that falls right inside their circle. And then they act decisively. Like Munger always said, all good investing is value investing. It's the art of getting more than what you paid for.
I love this next idea. It's from investor Howard Marks, and it's called the market pendulum. It's such a brilliant way to picture what's happening. He says market sentiment is always swinging back and forth, from total euphoria and greed on one side, all the way to absolute depression and fear on the other. Now, the speculator gets swung around by that pendulum, but the intelligent investor, they understand where the pendulum is, and they use those irrational extremes to their advantage.
All right, so the philosophy is great, right? But how do we actually use this stuff? Now we're getting into the practical, actionable tools. We're going to start with the first of 3 critical questions that make up a really powerful investing framework.
So before you even think about looking at a stock price, the very first question you have to ask yourself is this: how strong is this business? Is it a company that can defend its profits for years to come, or is it one that's eventually just going to get crushed by the competition?
And honestly, one of the best toolkits out there for answering that question is Hamilton Helmer's 7 Powers Framework. It gives you a checklist for what we call durable competitive advantages, or moats. For example, think about network effects, right? A service like Airbnb literally gets more valuable to you the more people who use it. Or what about branding? Apple's the classic example. People trust the name and will happily pay more for it. Or some companies have high switching costs, making it a huge pain for customers to leave. Identifying one or more of these powers is the first huge step to finding a truly great business.
Okay, so let's say you've done it. You found a great business, it's got a strong moat, that's awesome. But a fortress is pretty useless if the people in charge don't know what they're doing. So the next step is to evaluate who's steering the ship.
And that brings us to our second big question, which moves us from the what to the who. How capable is the management team? Are they smart about how they use the company's money? And are they really acting in the best interest of shareholders, like you and me?
And the cool thing is, we can actually evaluate this stuff. It's not just a gut feeling. We can use Buffett's 3 pillars: ethics, competence, and motivation. First, are they honest and transparent? Second, are they actually good at their jobs? Do they allocate capital wisely to grow the business? And third, are they motivated? Do they have skin in the game with their own money on the line? This isn't some soft skill. It's a critical driver of long-term value.
And that brings us to the final piece of the puzzle. This is so important. You found a great business run by a great team, but even the best company in the world can be a horrible investment if you pay too much for it.
So this is the final question, the one that really connects our research on the business to the real world of the stock market. It forces us to ask, at today's price, is this stock actually likely to give us a good return for the risk we're taking?
And this slide, it's so simple, but it gets to the absolute heart of value investing. Price is what you pay. Value is what you get. The goal is dead simple. Pay a price that is comfortably below the value you believe you are getting in return. That's it. That's the game. And that gap, that beautiful gap between the price you pay and the value you get, has a name: the margin of safety. Think of it as your buffer. It's your protection. Because let's face it, the future is uncertain, our predictions can be wrong, and bad luck happens. The margin of safety is the cushion that protects you when things go wrong and supercharges your returns when things go right.
All right, we have covered a lot of ground, haven't we? We've gone from the total chaos of a market frenzy to the calm clarity of a real investing framework. So now, let's boil all of this down into one simple, actionable playbook.
So here it is. This is your playbook, your cheat sheet. Think of it as a simple 3-question filter to run any potential investment through. First, is it a great company with a durable moat? Second, are the leaders ethical, competent, and motivated? And third, the final check, can I buy it at a price that gives me a real margin of safety? If you can get a confident yes to all 3, you're not speculating anymore, you're investing.
And really, that's what it all comes down to, isn't it? Market frenzies, bubbles, manias, they're not going anywhere. They are a permanent feature of how markets work because they're a permanent feature of human nature. The only thing you can actually control is your own process. You can choose to be a racetrack bettor, getting swept up in the emotion and the excitement, or you can be an investor armed with a timeless framework. The frenzy is inevitable. The only question is, will you have a framework?